I just want to start out by welcoming everyone and thanking you all for joining the latest installment of Powering Business with Blockchain. For those of you who may be new to this series, during these sessions, we host leaders and executives from across different industries to discuss how they're thinking about blockchain technology in the context of their businesses and their industries, how their efforts have evolved and really grown over time, and really ultimately to showcase concrete and real use cases in the space. Just by way of introduction, I know our VP of Business Development, John Nahas, usually hosts these sessions, but I'm stepping in today. I'm Morgan Krupetsky, Director of Business Development for Institutions and Capital Markets at Avalanche. In my role, I work with a variety of different institutional partners across the financial services industry as they look to adopt blockchain technology and digital asset use cases, and ultimately on the Avalanche blockchain. So today, I'm really excited to be hosting a couple of these partners. We have Karn Soroya and Cliff White, who are building a decentralized reinsurance marketplace on Avalanche called Re. Throughout the session, we'll definitely get into more details about the reinsurance industry overall, the possible places where the industry might be ripe for improvement, what the Re protocol is aiming to solve, and why blockchain, especially Avalanche's Subnet architecture, was an ideal solution for Re. So before we get into it, Karn and Cliff would love to have you guys introduce yourselves, tell us a bit about your backgrounds, and maybe just like a high-level overview of what you're building with Re. Karn, let me maybe turn it over to you first.
Sure. First of all, thanks for hosting us. Really appreciate it. By way of, I guess, a quick background, started my career at Oliver Wyman in their financial services practice as a management consultant. I moved quickly to doing something that wasn't finance related at all. I built an e-commerce marketplace where I sold high-end fashion on the internet called StyleKick. Ended up joining Shopify as a relatively early member of the product team. Left Shopify to build what turned out to be an insurance company, Cover, over the last 6.5 years. And now, working with Cliff and much of the original Cover team on building a decentralized reinsurance marketplace akin to a Lloyd's of London. Maybe Cliff, you can take it over. We can jump into what Re is.
Sure. Hi, and thanks everyone for joining. Thanks for having us today. I'm Cliff White, currently heading up the software development efforts here at Re. Before Re, I spent about 2 decades in the industry, mostly leading software development teams. Pretty early on, I got my taste of kind of high throughput websites at ImageShack, a top 20 website at the time. I know it's kind of a dinosaur at this point, but learned a lot about building data centers and high throughput websites and infrastructure there, where I really led me into my next endeavor at Kiteworks, where ultimately I spent about a decade in cybersecurity, building distributed systems that were primarily based in private cloud environments, helping enterprise organizations securely manage their infrastructure and data. But then I moved on to work with Karn and develop the infrastructure and team at Cover, and that led us into the decentralized efforts we're building here at Re, and I'm really excited to present this all to you.
Yeah. So just so those of us that are not familiar with reinsurance you can think of as insurance for insurance. So we quite literally back other insurance companies and other specialized programs called MGAs that have a viewpoint or domain expertise within a particular business line. And this could be aviation, this could be transportation, this could be agriculture. And what Re is a protocol that sits on top of a commercial general reinsurer that maps the insurance policies that are sold into agriculture, aviation, transportation, with alternative investors and risk capital providers that come from the crypto ecosystem. And so at a very high level, you can think about us as kind of like a decentralized Lloyd's of London and a capital matching mechanism.
Awesome. Thank you both. And I think maybe before we get into a little bit more detail about Re and the kind of mechanics and benefits of it, Can you guys say a little bit more about kind of the current state of the reinsurance industry today? So particularly for those who might not be as familiar, if you could just give us a rundown of, what works, what doesn't work, what's the size of the market? Like, what are we talking about here in terms of the industry and potential opportunity set? And like, what are we trying to address?
Sure. So this is nearly $1 trillion market, right? You have these massive pools of capital that act as kind of ballast, as shock absorbers against, what you would characterize as nature's casino, right? A broad cross-section of short tail risks, which could be, auto insurance policies, all the way to risks that are very binary, and earthquakes, hurricanes, floods, and other catastrophic risks. And so, the current state of the market, before I jump into kind of what we're doing to augment reinsurance, is a little bit in flux, right? With Hurricane Ian, you've seen massive losses being absorbed by monolithic reinsurers in recent months, and quite a bit of traditional capacity being pulled out, and where that's leaving reinsurance in this current market is a lot of programs, a lot of insurance companies are going to be under reinsured, or rates are going to be rising pretty quickly. If you zoom out a little bit outside of kind of the cyclicality of reinsurance, the major challenges, and this is a business that is chock full of really, really smart people that are focused on underwriting, but where the structural challenges lie are largely in and around transparency of the types of risks that each of these monolithic reinsurers are taking. And that's kind of a consequence of the data that they use to make underwriting decisions being very, very siloed. You can think about insurance contracts as being very long dated. And so the capital that's required to back those insurance risks tends to be locked up for quite some time. And so you have liquidity challenges that aren't necessarily attractive to traditional investors who could otherwise just buy an ETF and earn a rate of return that's over and above what the ROE for reinsurance looks like. And then you have a lack of being able to leverage the massive amounts of capital that sit there to be able to absorb these risks. And we're finding that by incorporating elements of DeFi, some of the commoditized elements of this business, we solve for many of those problems. Cool. So that's the current state of the market. It's huge. Where we're headed is largely taking these deals, tens of thousands of small business policyholders paying premiums, to be protected against potential losses. The specific economic treaties that back in the contractual flow that back those deals are going to end up memorialized on chain. So the world, regulators, investors, cedents, which are insurance companies themselves, with RE can take a look at, what is it that RE is backing at any given point in time, and also what is the capital that's backing those risks at any point in time. And so these types of tools have never existed in reinsurance before, to the benefit of regulators or to other cedents. And what we're finding is that by being transparent in this way, it actually enables things like liquidity. If the world knows exactly how much capital you have sitting around, and the world knows exactly what's on risk at any given point in time, there's a degree of credibility there that enables folks to be able to do things like, package up these treaties in the form of NFTs or security tokens and trade them on secondary markets, or to be able to tokenize the surplus capital layer that's backing all of these treaties and treat it akin to something like a stable coin, where now you earn a return for taking risk, you earn investment income, but you also are able to leverage this illiquid surplus space on other DeFi protocols. And for folks who haven't kind of lived at the intersection of or not super DeFi aware, or not necessarily super reinsurance aware, the intersection of these two things is really non-obvious, but you can garner an understanding of how we're thinking about it by simply looking at what Circle does with USDC, holding US dollar reserves as we would as a reinsurer, and tokenizing those reserves for the benefit of broader DeFi ecosystems. But in the context of reinsurance, we're talking about $1 trillion potentially of capital that sits around to support activity in broader DeFi, but also to back real world insurance risks.
So from a blockchain perspective, I'm hearing what that enables based on what you just said, the transparency component, which I guess at this point, off-chain isn't as apparent or possible, as well as enabling liquidity, whether that's primary or secondary market liquidity, and then unlocking a lot of maybe historically trapped capital that is enabled kind of by putting this process on chain. And then in addition, and maybe you could talk about this also, a lot of times when we talk to different institutions and enterprises, it's less about disintermediating industries and more about kind of disentangling certain processes for kind of the current state. So potentially by bringing all of these disparate stakeholders and parties onto one shared platform, it can kind of address some of that and disentangle some of that process and inefficiency for those kind of involved. Would you agree with that in terms of the disentangling component?
For sure. I mean, at the end of the day, many of the contracts that back reinsurance treaties effectively say the same thing, but are in non-standard formats, right? The communications between underwriters, communications between parties that are originating the business, underwriting the business, backing the business with capital. There's an incredible amount of information that's lost from when the policy is first originated, all the way to the person who's trying to determine whether or not they should take the risk or not. And so in this way, if you've got a protocol that is memorializing the economic terms of each of these treaties, if it's memorializing the capital, you now have a standard format for representing each one of these deals that can be packaged up and traded and ultimately evolve to a place where these things can automatically execute without necessarily a significant amount of administrative overhead. And that may not be the case right out the gate as you kind of figure out what, you start to move into new lines of business, and there are perhaps a number of parameters you need to consider over time. But over time, you can force some sort of standardization. By forcing standardization, you can bring more capital in because people are now able to more readily assess, what it is and what the risk is that they'll be partaking, or at least being party to at any given point in time. So yeah, it is that if you zoom out even a little bit more, you can think about it as kind of like a third-party contributory database, right? So you have policyholder data and data that's necessary to determine, what the price of an insurance policy or insurance coverage should look like. That exists in spreadsheets and Word documents. And instead, it could be on-chain and available to really, really smart people around the world, actuaries and underwriters that want to take a look at each of these individual deals from the comfort of their own homes. And you have now these really, really smart people put up their hand and say, I'm going to take risk on this and put up my own capital and have the protocol come behind it and help me actually transact this deal. And in many ways, this is arcing back to where insurance and reinsurance actually started, right? Reinsurance and insurance started as a collective of individuals pooling capital together to be able to absorb, shock losses against any individual parties within that pool. That transformed into monolithic reinsurers like Munich Re and Swiss Re, where you have specialized teams within a single monolith and a single capital pool, which in and of itself drives some inefficiencies, but still concentrates capital. What we're saying now is that you can debundle that and be able to come up with better underwriting outcomes and easier access to capital if it is on chain and available there.
And so based on that, maybe let's dig a little bit further into RE itself. I know you guys published your white paper and it's available publicly online, but maybe can you just walk us through kind of the different participants that make up the protocol, the roles they play, like why they're important, and then also maybe walk us through like a transaction from an insurer's perspective. So if I'm an insurer out there and I want to potentially benefit from the protocol, what do I need to know? How does it work? Like if you guys can start digging into a little bit more about that, I think that would be helpful.
Sure. So we didn't start from scratch. We're modeling RE after roughly 300 years of evolution in a reinsurance marketplace called Lloyd's of London. And Lloyd's of London is a physical marketplace where reinsurance brokers, so these are folks who go out and talk to insurance companies and MGAs, which again are specialized underwriting entities, and effectively work with them to be able to find capital to back the risks that they originate. So reinsurance brokers will go to a Swiss Re or Munich Re or Lloyd's of London with data. This is premium data and claim data, presented to underwriters and actuaries who are there. Those underwriters and actuaries are trying to determine what the expected loss of those losses on those policies will look like. So they run actuarial analysis predicated on the data that's presented to them, and then make a decision. What's the price? What are the underwriting parameters? And what's the capital that needs to kind of flow behind that particular deal? And so at Lloyd's, you have cover holders, you have syndicates like we do at Re, which are teams or specialized teams of underwriters and actuaries. And in the historical context at Lloyd's of London, you have names, which started as high net worth individuals supplying capital to the syndicates to take the risk, and eventually morphed into institutional investors who are supplying capital to syndicates to be able to take risk. And we look at that and thought of that as probably a very good archetype for what we would want to represent on chain. And so we do a lot of what Lloyd's does. We work with reinsurance brokers to be able to onboard programs. And so, as of today, we're just under 40 million in premium over the course of the last couple of months. But we're backing tens of thousands of small businesses. We're backing tens of thousands of hospitality workers for workers' compensation. Those deals came in from reinsurance brokers with data that was assessed by distributed teams of underwriters and actuaries, which are syndicates on chain. And the capital that comes in to back those deals comes from the protocol itself, right? So as long as there's interest by sophisticated actors who are willing to put up their hand and say, we think this is a good deal, we have some skin in the game, and we're going to put capital or governance tokens, the protocol responds in kind by being able to back the rest of that deal. And what's neat about what we're doing is starting with a substrate of something that exists and it works. By memorializing everything that exists and works on chain, you can start to do really, really interesting things like cut up these individual deals into tokens, make them tradable in secondary markets. And for those who are insurance aware, if you've got a whole bunch of programs that you're backing, you could quite literally bundle them up and trade them like they would be insurance-linked securities on secondary markets. And so there is a future here where you have data that's somewhat standardized and readable and understandable. And because as a consequence of how it's set up and the interoperability between distributed applications, anyone who can read our smart contracts and build really interesting things, either liquidity or synthetic derivatives on top of kind of the basic economics of each one of these deals. So starts with something that works and then augments it with existing technologies, kind of where we're headed.
Yeah, and I think you're already alluding to something that I think we'll talk about in a bit, is just the idea of eventually, we see a world where these tokens are kind of being incorporated increasingly into the world of DeFi, and what that could potentially look like and enable is obviously really exciting, and part of the reason why a lot of us are here. I wanted to ask one question that actually just came through in the Q&A that I think might be relevant before we go into this from an investor perspective. But from a regulatory standpoint, I think it's worth outlining the nuances, particularly for the traditional industries, where just because something's on chain or something is very clearly a security token and not a pure cryptocurrency, like generally speaking, we're not trying to obfuscate regulations. If there's a clear regulatory framework, all the partners and projects that we work with, try to or intend to kind of abide by existing laws, rules, and regulations, or they exist. So from a Re's standpoint, how do you guys take into consideration and how do you look at like the right potential regulatory, the environment, as well as any changes? How do you account for, rate changes by specific states or new businesses or existing policies? Like, how does that get incorporated?
Yeah. So I'll start with the last part. We actually don't sell policies directly, right? We back other people who sell policies. And so, if you were to participate at some point, you're interested at some point or another, you would provide capital to the protocol and you would start earning premiums from tens of thousands of small businesses or farmers or transportation companies or whatever it is that is being backed at a given point in time. And you'd earn a return that's uncorrelated with cryptos and equity markets. What 10,000 businesses are paying you is kind of unrelated to what's happening on the NASDAQ or during crypto winter. From a regulatory perspective, we've endeavored to be above board every step of the way. So, when you and Cliff will cover this, when you onboard through us, we do require customers or members to go through KYC AML and be whitelisted on the Securitize.io platform. And so it's compliant with Reg D, Reg S. From a reinsurance licensing perspective, we're already a licensed commercial general reinsurer. And so we have the capacity to take risks just about everywhere outside of the EU. And eventually we'll be able to do that as well. The critical piece here, and this is kind of like threading a fine line between the crypto community and the insurance community, which is not necessarily crypto aware, is helping folks understand in the insurance space that we're actually not tying ourselves to volatility in the underlying assets. What we're doing is we're building on top of infrastructure, blockchain infrastructure, that makes this business 10x better. A regulator can now go in and trivially query, what risks or programs are on chain at any given point in time. They can't do that with other reinsurers. They can go and they can query what capital is backing those deals at any given point in time. Again, you can't do that with traditional reinsurers. That helps build credibility in a way that I think would not necessarily be possible if we weren't that transparent. And so from a regulator and investor's perspective, you can kind of think of this as elaborate in very transparent accounting software sitting on top of a reinsurer that enables a whole bunch of really interesting applications, right? And then there's a question of evolution of a regulatory environment, right? And I think so long as we are being forthcoming with regulators around the tooling that we're building and what we are building, any sort of leaps, perhaps now we want to reserve in USDC or in DAI or something else. That is a process, that we need to help inform regulators and work with them hand in hand to be able to adopt over time. And believe it or not, that's happening. It's happening in Bermuda. It's happening in Cayman. It's happening in a whole bunch of different domiciles that are kind of at the forefront of thinking around this. When it comes to state by state in the United States, insurance is regulated at the state level. So you can think of that as kind of like 50 different regimes. Again, the path here for us is to be sure that we're building things to the benefit of investors and regulators, as opposed to trying to obfuscate what it is we're trying to do. And so long as you're acting in good faith and being clear and forthcoming, the regulator gets to do their job. They make sure that the customer is protected, and we can help support them in that endeavor.
And I would like to just emphasize, and thank you for that. And I would just like to emphasize something really important, I think, that you just said, especially in the context of current market developments in the industry, is that I think generally speaking, there's a consensus or a view that the issue, so to say, isn't with the underlying technology, and that's something that I think you guys are proving out with your protocol, and kind of proving that and proving the nuance that it's not crypto writ large. It is still utilizing the underlying blockchain technology to improve upon systems and processes in an industry that that has scope for improvement in terms of efficiencies and transparency and all that stuff that is partially why we're all here in the first place. So that is nuanced, particularly I think for those that might not be deep in the weeds with us in and out every day, but it is something that I think to your point is worth repeating and emphasizing, just given market developments. But thank you for that. And I think maybe just as a next question, and Cliff, I think you might be showing us this, but from an investor standpoint, I know it was mentioned, investment in this industry has historically been, limited to institutional investors. And now I think with protocols like RE and others who are tokenizing real world assets, bringing financial assets on chain, real yield, real utility, yields that is uncorrelated with broader markets as well as cryptocurrencies writ large. In this case, obviously, you guys are tokenizing reinsurance. you're able to now offer this as an investment to a much wider group of potential end investors, which obviously will start to include increasingly more individual investors. So can you talk us through maybe how you see tokenization enabling this wider participation? What about it kind of opens up the investment universe for them? And, if someone's interested, what does that look like? And before we kind of go in, just want to emphasize there's no financial advice. Please do your own research, so on and so forth. But, for those who might be interested, talk to us a little bit more from the investor's perspective. What does this mean and how do they learn more?
Sure. So as we alluded earlier, there's kind of two sets of investors that are part of this ecosystem here. There's the DeFi and the crypto type of investors, and then there's the more traditional institutional type investors. And both of those really are targets of the protocol as we look to acquire more capital to provide reinsurance capacity. And we're building software to support both of those. We're building software to support a multitude of different actors within the protocol to alleviate some of the complexity that you talked about earlier as far as processes go. Not only processes with regards to the accounting and the acquisition of capital, but also the operation of the reinsurance organizations itself, and operating that on a distributed, decentralized platform. In automating all of it saves on a huge amount of operational overhead in the end. But when it comes to targeting and making accessible the investment platform out of the gate to these institutional investors, we've partnered with Securitize to really take care of the KYCing and the AML of these investors, and giving them access to deploy their capital in an efficient way directly into the protocol. And I can show you what that might look like and how we've really made that pretty easy here. So ultimately, here, we'll go over to the, can you see the screen here? All right.
Okay.
All right. So when you come to the website, and re.xyz is live today, we're building the software that will allow you to operate as if you were a traditional investor on the web, looking to deploy your capital into Re. And you'd come to the website, and as you onboard into the system, just like with any Web3 DeFi application, you'd be first asked to connect your wallet. And we'll take you through a few steps, but we hold your hand the entire way. And as soon as you connect your wallet, you'll be asked to link your Securitize account. And this is where we bring in that Securitize ID, where a lot of investors probably already have an ID at this point. And they're going to take care of onboarding us and collecting all of the necessary information to verify that they're accredited investors. So after that's done, you'll be able to deploy your capital into Re directly from the Securitize portal. And then you'll be able to verify and monitor your transactions and your account back at the Re protocol website. So this is where we'll ultimately provide all the information on changes to the protocol, new reinsurance opportunities, your ability to take part in the protocol in other capacities beyond simply investing. And this will be your centralized hub to access the protocol at large. So that is more or less the demo at this point. Let me bring back up.
Looks very sleek.
It is. Thank you. We worked really hard to make it really, accessible to both of the personas that we're looking to attract capital from.
And that was really helpful. And thank you. And maybe if you guys can just talk a little about why does the tokenization component allow individuals to invest? Like, what about it makes it, is it more economically viable? Is it the transparency component? Like, what about it enables now me as an accredited investor to be able to have access to this? Whereas before, maybe the access was closed off, or I'd have to go and potentially access it through, private wealth manager. Like what about it kind of enables me to have that access now?
Well, it's traditionally, in a private placement offering like this wouldn't be accessible unless you had direct knowledge of the offering, right? And once you're inside of the securitized ecosystem, in this case, you'll be able to buy these shares or these positions, and you'll be provided liquidity even inside of the lockup period of the shares by being able to interact with other members of the ecosystem and sell your position at that point. So that's an important attribute, and I think it's an attractive piece of the offering for a lot of the investors looking to get involved with an asset class that they didn't traditionally have access to before. You can't go on and buy into a specific reinsurance treaty in other marketplaces, and Securitize and the RE protocol gives you access to do that. At the same time, all of the information being published on the blockchain in this situation gives you the ability to verify the underlying operation of the protocol in a way that you wouldn't be able to do in a traditional investment. Karan, anything you want to add to that?
Yeah, no, I agree with what you said there. I mean, the fact that you can now trade in and out of positions in a liquid asset class is a massive win, right? Traditionally, you either have surplus capital base that's sitting and it's locked up, and you can maybe access it synthetically through an equities position, or you have network access. You can participate in these sidecars, these SPVs or ILS funds that give you some exposure, and is usually to catastrophic risk like earthquakes or hurricanes. You get paid quite a bit until you get wiped out. Here, what we're focused on is low volatility lines of business. We're trying to hit singles and doubles and deliver a predictable return, and give you the optionality around liquidity in and out of those positions in a way that doesn't exist today. Yeah.
I think that's such a key point. I think obviously for your protocol, but even just for the value proposition for bringing real world assets on chain, particularly those that are historically illiquid, the tokenization component really enables this secondary market liquidity, whether it's to sell out of or trade your position in a way that, again, historically was just not feasible. So to the extent that, I think Karan, you mentioned this earlier, the idea of potentially incorporating these tokens into the world of DeFi, similarly, the idea of enabling liquidity, particularly for individual investors, I think is a huge revelation that I think we'll start seeing more so develop over time.
Yeah.
So that's huge.
The beauty of it is we actually don't need to build some of this stuff ourselves, right? Anyone who can read our contracts is going to be able to point to them and create these synthetic methods of being able to create liquidity, which is it's an open ecosystem. And that doesn't exist in reinsurance or insurance in general.
Yeah, that's a pretty great downstream effect of what we're doing here, is the fact that everything will be published on the blockchain, and that's going all the way up to the insurance company looking to acquire reinsurance. They're going to be publishing all of that risk information all the way down and possibly into derivative markets that are producing vehicles or products that we hadn't even thought of yet.
I'm excited for all this to kind of unfold over the coming months and years. But maybe if we could switch gears a bit and talk about, in particular, your decision to launch on Avalanche. From our side, from an Avalabs perspective, a critical part of our roles is to really spread awareness and education about the Avalanche platform and what differentiates it. But obviously, it always means a lot more when we have people and partners directly kind of more speaking about it. So maybe from your guys' viewpoint and kind of given the requirements that that you had for RE, maybe just walk us through your decision to launch on Avalanche. What about it made it fit for, ideal for RE in particular?
Sure. So there's really three primary reasons. And from a technical perspective, speed of the network, efficiency, your ability to very simply get onto the blockchain and operate on it from a number of different use cases. And then really the most important one for us was the flexibility of the blockchain itself. And that goes from our ability to deploy, existing ERC20 tokens onto the blockchain and interact with them, all the way down to the feature that allows us to deploy our own subnets. And this is really the key one right there, because as we know, not everyone wants all of their information published to the entire world, and the subnet optionality will give us the ability to permission some of that data at a certain point, and allow people to operate sort of in a decentralized fashion without any changes to the overall protocol, or having to look for a new technology to power that aspect of the business. We don't have to move anywhere. So Avalanche gave us that ability, and we're really excited about that. And the options that gives us into the future that we haven't even come up with yet. We're coming up with new ideas of how to leverage subchains pretty much every day, and that's kind of the technical reason why we would do that. Other than that, it's a fantastic protocol. The blockchain itself, the community at large, has been very supportive and helpful, and we're really excited to be involved with Avalanche.
And thank you, Cliff. I appreciate that. And can we maybe just dig into a little bit more like how the subnet component works? And part of why I want to dig into that a little bit more is because I think that when we speak with different enterprises and institutions, we always talk about, subnets kind of give you the best of both the enterprise chains, the enterprise blockchains that probably a lot of different people are familiar with, that mixed with, the benefits of a public permissionless chain and what that can enable, and the native integrations that come with it. And so you guys are really interesting, or Ree's really interesting in that, as I understand it, it's kind of employing a hybrid approach where there's a component on the C chain, the public permissionless smart contract chain, with the subnet component. And to your point, you mentioned part of that is to preserve, certain sensitive information, PII, but can you maybe speak a little bit about what that interaction would look like and kind of your path in terms of how you came to that, that mix?
Sure. So out of the gate, everything can live on the primary chain, right? We're just going to build everything to exist there. But and you can see this in the enterprise world. A lot of organizations are wrestling with the fact that, well, I'd like to be on the blockchain, as they'll call it, and that's very non-specific, but I can't control it. I can't control who has access to it. I don't know who's validating. I don't know who's interacting with it. And for them to take on building something like that from scratch, or deploying their own chain, and all of the kind of nuances that go along with managing a project like that, that spirals out of control very quickly and becomes very expensive, and the upkeep with it is out of control. So what a subnet gives you is that private blockchain functionality with all of the benefits and upkeep and interoperability of the Avalanche primary chain on itself. So, you can decide to deploy a subnet in a certain circumstance where the requirements call for, you need your validators to be in a certain country, or you want to deploy certain rules to your subnet that you don't think will ever be valid on the primary chain. And that's very advantageous when you have a situation, for example, if a certain reinsurance treaty had rules where it has to operate with, only very specific people need to have access to verify the data on that chain. That's a very specific requirement that a subchain would allow us to implement without changing the entire protocol itself or changing how the blockchain itself worked. The subchain would allow us to do that. And the future development and the upkeep and all of the benefits that come along with Avalanche and the blockchain on a whole, we get for free, right? So allowing us to leverage what we would get in a private development setting with all of the benefits of it being developed by the community and carried on by Avalanche on a whole is very advantageous.
Got to get you onto a commercial to go through this, but no, obviously couldn't agree more. And I think, again, I think you guys are utilizing the architecture in a way that is a novel application so far, but is really, I think, taking advantage of the best of both. So it's really exciting to kind of see partners kind of recognizing their needs and the benefits of what Avalanche could provide. So So appreciate that. And I think we've spoken a little bit about kind of the future of what re could be and where you see the industry potentially moving. But, as you guys kind of look ahead, and I think we always say like we're still super early, right? There's a lot of education to be done, and it'll take a while, I think, until we see kind of full adoption of this space writ large. But as you guys kind of look ahead 5, 10, 15 years down the line, what are you imagining the reinsurance world could look like once this becomes kind of the new normal? Like, what does this mean for all the participants involved? And maybe like, what is like the target state, North Star vision that you're working toward? Or is that just so far away that it's like a little dot right now and we don't even know what that looks like?
I think it's fine to dream. What I envision is that a standard format or a global transaction layer for the settlement of this type of risk is going to emerge, either through re or folks who are building on top of re or off of re. And it's going to, enable more efficient pricing of this risk. It's going to enable more transfer of this risk. You're going to have whole industries like the entire insurance-linked securities market, which is many hundreds of billions of dollars, now replaced by this type of infrastructure that is more seamless to transact with. The transactions are immutable. The data is standardized. And then, we talked about this a little bit in the earlier part of the conversation. This is kind of reinsurance and insurance coming full circle, right? We're going to arc away from monoliths that may not necessarily be particularly efficient in underwriting and pricing risk, and efficient in deploying, or as efficient as it could be in deploying the capital to back those risks. And it's something now where you're able to harness human ingenuity and capital from around the world to be able to back all sorts of risks. So you're going to see expansion of capacity, you're going to see expansion of capability. And generally speaking, it's going to lead to an outcome where you have resilience in backing, people, businesses, and governments to do things they need to do. So it's a lofty set of goals, but readily achievable by kind of what exists today and what it will evolve into, on chain. That's how I'm thinking about it.
And what do you think might be, just from your perspective, some of the challenges associated with it? I mean, we already talked about, obviously, the education component with respect to all parties, I think. What other challenges? Is it generating liquidity? Is it, the regulatory component? Like, what do you see as potential kind of roadblocks or hurdles that you guys have kind of foreseen and are thinking about?
Yeah, I mean, in the near term, you've hit it on the head, right? Most people don't know what reinsurance is, especially within crypto. And then
I learned a lot already, and I came from the traditional finance.
Within crypto, like within insurance, there's a bit of a stigma around it being particularly volatile. And I think we're addressing that head on by being incredibly transparent and forthcoming with respect to what exactly it is we're building and what exactly we're reserving with. And then from a crypto asset holder's perspective, this is just a dramatically, it's a very interesting way to deploy capital if you are thinking about earning a return that isn't necessarily correlated with the highly volatile underlying crypto market or with the NASDAQ in general. And it's kind of the near term. What happens over time is I think you'll have folks and regulators open up to being able to reserve in other assets. And there are examples of that starting to happen. Reserve, if you've got Bitcoin exposures, you reserve in Bitcoin. If you've got ETH exposures, you reserve in ETH. In our particular circumstance, we started with real world risks because there's already product market fit there. We know that $1 trillion of this stuff is transacted every year, and that we could get a running start by being able to back people, businesses, and potentially governments as kind of the onset. But the folks that are working on smart contract exploits, smart contract failure like Nexus Mutual, Ether Risk, all of these folks I think are directionally correct in their assessment that insurance products and reinsurance products are going to be necessary. We just think of that as probably the next step after real world risk, and it's still a couple of years out by my estimation.
Yeah, I mean, I think I think that's helpful. And I think just given where we're at from a macro market conditions perspective and crypto winter perspective, I think that we've seen an increased interest and almost like sense of urgency to bring real world assets on chain and bring real yield on chain in a way that, I mean, again, I don't think that the concept of like tokenization is necessarily new, but just where we're at from a cyclical perspective, I think we're seeing a lot of interest, whether from protocols, from more traditional asset managers, to really accelerate efforts into bringing real world assets, those that have product market fit and an embedded demand base on chain. So it's really exciting that, that it's all happening.
Yeah, it's not just going to happen in reinsurance, by the way, and anywhere where a distributed pool of capital can be brought to bear to back existing financial products that could be executed on chain will happen. It's not just reinsurance. It's going to touch everything.
I think that's right. And so from my side, these are all the questions that I had for you guys today. Thank you guys again for joining. Just want to ask and kind of give you the opportunity, any parting thoughts or takeaways that we didn't cover, anything that you just want to emphasize and maybe leave the audience with before we wrap up? Or did we cover it all?
Oh, we did cover a lot, and it's exciting that we were able to get all this, out into the public domain and explain our position and our partnership with Avalanche. So thank you.
Yeah, thanks for having us. If any of you are super interested in what we're doing, feel free to reach out. You can sign up as on the wait list as a member to join our newsletter. You can also just reach out to us directly, just karn@reit.xyz. Cliff, you're okay with me giving our email?
Give it.
Cliff@reit.xyz, and happy to jump on, have a chat.
I was going to say we might all regret that because I was going to give mine too. But again, I'm really glad that we got a chance to have you guys on the Powering Business with Blockchain session, and really again just like deep dive into what you guys are setting out to do with Re. Would also highly encourage everyone to read your white paper. I thought it was really interesting as well. I know it's on your website. And last but obviously not least, want to thank our audience for joining us today. And listening in. Before we do end, I just want to note that since August, we've been sending out monthly ecosystem newsletters called the Avalanche Snow Report that are meant to highlight, the major developments across the Avalanche network and ecosystem. Re obviously was featured in historic editions. So if you're not kind of deep in the weeds with us day to day, I think the Snow Report is a great kind of higher level wrap up of each month's major development. So those of you who signed up for this webinar through a personal email invite should automatically be receiving this report, but do let me know if that's not the case. Happy to get you signed up. If anybody has any questions about anything you guys heard today about Avalanche, about Avalabs, please feel free to reach out to me over LinkedIn or via my email, morgan.krupetsky@avalabs.org. Thank you all again. Cliff, Karn, thank you guys again, and we will see you all soon.
Thanks for your time, y'all.
Thank you.